and welcome. In this video, we will look at buying a call option for speculation. For this example, I'm using SLV, the silver ETF. At the time of making this video, SLV is $19.42 a share. Let's say that a trader is bullish on silver short term, so he wants to trade 1,000 shares of SLV. Instead of buying 1,000 shares of SLV, the trader buys 10 Febuary SLV call options that expire in about 6 weeks. A call option locks in a preset buy price for an asset. By buying call options on SLV, the trader is locking in a preset buy price. If the price of SLV should rise above the locked-in buy price, the trader can use his option to buy SLV at the price he locked in, sell it for the current higher price, and make the difference in profit. Let's look at the 1950 Febuary call option contract. The 1950 strike costs 62 cents up front. This contract locks in a preset buy price of 1950 for SLV over the next 6 weeks. SLV is currently 1942, so this option is out of the money. In other words, it has no intrinsic value. The value comes only from the fact that the price of SLV moves, in other words, the volatility, and that there is time for SLV to possibly move to above 1950. If the price of SLV moves above 1950, this option begins to have intrinsic value. However, if the trader chooses to buy this contract, for the trade to be profitable, the price of SLV has to move to 2012 or above to cover the cost of buying the option contract. Let's say that the price of SLV climbs to 2012 or above. The trader uses his options to buy SLV at 1950. He then sells it for the current price of 2012 or above. He paid 1950 for SLV, and he pays 62 cents up front to buy the options, so his total cost is 2012 a share. If he sells SLV above 2012, the difference is his profit. For instance, let's say that SLV climbs to $21. The trader uses his options to buy SLV at 1950 and immediately sells it for $21. Therefore, he made $1.50 a share. However, his upfront cost was 62 cents a share, so his net profit is $1.50 minus 62 cents for a net profit of 88 cents. It is important to note here that in most cases, the trader would not use this option to actually purchase and sell SLV. In most cases, the trader would simply resell the option for a profit instead. If the price of SLV climbs above 2012 within the next 7 weeks, the trader makes a profit. If the price of SLV climbs above 1950, but not up to 2012, the trader loses money. The price of SLV is above the 1950 strike price, so the trader does sell his option, but the price he gets for selling it is less than the original 62 cents he paid up front. If the price of SLV stays below 1950, the option expires unused, and the trader loses the 62 cents he paid up front to buy the calls. So let's recap. The price of SLV is 1942, and the trader feels the price of SLV will rise within the next few weeks. Therefore, he buys 10 SLV call options that expire in 6 weeks. The options lock in the right to buy SLV for 1950. This means that for the trade to be profitable, within the next 6 weeks, the price of SLV needs to climb not just above the strike price, but far enough above the strike price that the difference the trader makes in profit is enough to cover the original upfront cost to buy the option contracts. The 1950 call was not the trader's only choice. In the next video, we will look at other strike prices that expire the same month, with emphasis on the difference in upfront costs, in other words, the amount the trader must risk, versus how much SLV needs to increase for the trade to be profitable. I hope you enjoyed this video. Thanks for watching.